Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is The Art of Losing. This is Shane Chu. I'm the moderator for this webinar. And before we begin, as usual, disclaimer. Whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Today, we're going to talk about the art of losing, which include what are the common mistakes that retail investors often make, what are the biases, and how do we avoid all these pitfalls. And joining us in this session is our guest speaker, Mr. Chew Huat Jin, a reminder from Malacca Securities, to share with us his knowledge and perspective about the art of losing. So allow me to briefly introduce Mr. Chew's background. Mr. Chew has an extensive background in the financial services industry since 2005. And currently, he offers portfolio management services for separately managed accounts, providing customized solutions to his clients. So he conducted more than 200 seminars, workshops, trainings, and sharing sessions covering a wide range of topics related to investing and trading. So today we are very honored to have Mr. Chew joining us today in this session to discuss about the art of losing. So Chew, how are you today?
Hi, I'm good. Hi, good evening, everyone. Thank you, Shane, Busa, and LifeChamp. It's good to be here.
All right, cool. So I'll just stop sharing my screen and you may take it over.
Okay.
Yes, we are seeing your full screen.
Hold on. Okay. Hi, good evening, everyone. So a little bit about myself. I started my investing and trading journey 20 years ago with Malaysian stocks. And then in 2005, I expanded ventured into Hong Kong and China stocks, and followed by the US stocks in 2008. And then 2017 into Europe and some other countries' markets in 2017. So over the years, I'm lucky to be able to experience and witness different market cycles, like the bull market in Malaysia before the global financial crisis, and the bull market in Hong Kong and China market, and then the bull market in the US market, and of course the bear and sideways trends, so in different markets. And along the way, I've tried and experimented or backtested many different trading and investing strategies, from swing trading to even trend following, value investing, to even turnaround plays, and made, of course, many mistakes. And the good news is most of the strategies work, and provided we can stick to the plan during tough times. Except for maybe asking the fortune teller which stocks to buy or whether the market will go up or down. I've tried that. That can't work, but most of the strategies work. Okay. So today, I hope to share with you some of these lessons so you can avoid the same errors that I've made over the years, hence the title, The Art of Losing. Okay, so if you have investing in a market long enough or for several years, I'm sure you have come across this kind of information whereby it says that most investors, including the professionals and even the hedge funds, underperform the market in the long run. And according to this study published by the S&P, only a small percentage of US and international equity funds manage to beat their benchmarks over a 15 to 20 years horizon. So this is one of the reasons why low-cost in passive investing is so popular right now. And beating the market is no longer the focus for many investors. And passive funds managed to double their market share from 2013, 10 years ago, to nearly 40% in 10 years. So if we are passive investors, the only mistake we need to avoid is to panic sell when the market is near or at its bottom. But if we are active investors, we'll have more problems, like on top of avoid selling when the market is at its lowest. We may maybe pick the wrong stocks and subsequently underperform the market, or we may switch to a different strategy after, say, a period of underperformance, then only to see the original strategy beating the market again. Then we have to switch to another strategy. or we may analyze a certain information incorrectly, or miss out on the best stocks, or hold on to losing stocks. So, and the list goes on. So in order to beat the market, we have to beat other investors. So do we have what it takes to win? Because in the market, there's always a buyer for like every seller. So how do we know that we are better than the person on the other side of the trade? So investing or trading edge refers to something that gives us an advantage over other investors or traders. So for informational advantages, is finding information that others don't have. So this is how Warren Buffett made his money in the 50s. So he can turn over like 1,000 pages of Moody's manuals. It is kind of thick, and find bargains like stocks that trading at a very low price to book ratio or trading at very low PE. So as there was no internet, it was hard to find financial information or even annual reports in the era. So in the early 50s, Warren Buffett wrote an article for a newspaper. So the title is "The Security I Like Best." You should be able to Google this article. So it is an insurance holding company called Western Insurance. So the share price at that time was only like $16 and the earnings per share was $20. So it was trading at less than one-time earnings. So Buffett said he even ran advertisement in the local newspaper to try and buy the stock from like other investors. So there are investors who saw the news on the newspaper, so they sold the stocks to Warren Buffett. And then Warren Buffett put like 50% of his net worth into that investment. So the stock went all the way to $90 in 1955. So if one day Mr. Buffett tries to buy something from you, please don't sell it to him. Okay? So nowadays, we can find this kind of information with just a few clicks or through a stock screener, like the top 10 undervalued stocks, or maybe stocks with the lowest price to book ratios, or stocks with negative enterprise value. So, and then there are like even hedge funds that's the news I read the other day. There are even like hedge funds that are paying for satellite imagery of farms to like get an idea of what the crop use is going to be, or satellite imagery of Walmart or Costco or Tesla's parking lot, counting the cars and putting together some data to gain some advantage. But as time goes by, the informational advantage that Mr. Buffett enjoyed by simply looking through Moody's manual, I think it's no longer there, because the availability of information and the quantity of people analyzing it has taken this advantage away. So in today's world, informational advantage is not something that most of us can use to our advantage unless we are willing to like venture into smaller or riskier stocks. But in fact, too much news and information from, say, Bloomberg, CNBC, or even social medias can be bad for us sometimes. They can serve as distractions. Now, today, the information that a stock is trading at one-time PE, like or very low PE, can be obtained easily. But whether this stock is a value play or a value trap, that requires analysis. So analytical advantage is basically taking the same information and interpret it in a different or even a better way. So let's take Apple, for example. Even the largest stock in the market, there are a lot of information about Apple, right? But yet the difference between its one-year high and low can be as much as 60%. This represents almost a 1 trillion swing in the valuation of Apple's business. So if, let's say today, Apple is a private business, it is unlikely that the actual value of the business would change that much for a private buyer in such a short period of time. But that's what the stock market does. So in 2016, Apple has been able to maintain its high margins for a few years, but there are different views on whether Apple can sustain these margins. Like one view is that Apple is a hardware or in a consumer electronic business, which is very competitive. So when there are high margins, competitors like Huawei, Oppo, Xiaomi, they are likely to enter the market and they will put pressure on those margins, and Apple's margin will revert back to the mean at some point. But another perspective is that Apple is a consumer brand business. Like Coca-Cola, consumer brands have pricing power. So people will be willing to pay more for such brands. And therefore, Apple will be able to maintain its margin and even grow its revenue. So this demonstrates how two groups of people can view the same situation differently. And lastly, behavioral advantages are perhaps the most interesting. It is grounded in the fact that humans are genetically wired to like make poor investment decisions, and we are driven by fear and greed, which is a formula for buying at the top and selling at the bottom. So successful investing requires a struggle with ourselves because we are our own worst enemy. So to tune out those noises and to have the conviction to stick to the plan and maybe resist the urge to like follow the crowd. So the ability to like tahan the short-term discomfort and focus on long-term horizons can be a very good advantage over others. So now let's take having a long-term perspective as an example. So the market is very good at analyzing short-term data points like the quarterly earnings growth, and so on. So there is an intense focus on the short term, but I think the market does a poor job at judging the long-term fundamentals, as there are many factors that can't be put into an Excel or spreadsheet to analyze. For example, if you are studying software engineering and you are at the top of your class in a top university, so you might want to work in companies like Google, Amazon, or maybe join some promising tech startup. But most likely you won't join companies like Yahoo, right? So as a result, the best companies tend to get the brightest talents and widens their moats over time. Those things are important for the value of a business, but they are very difficult to measure. So as there's more and more short-term data available, the duration, or let's say the time frame to judge or appraise our strategy or performance became shorter. So for instance, investors may judge a fund's or maybe a strategy's performance on a monthly or maybe quarterly basis. So this will put pressures on the fund management companies to deliver good short-term results to retain its clients. So if you are working in an investment bank like us or a stockbroking firm like us, some of our clients even judge our performance on a 2 to 3 days basis. So if the stocks that we recommended does not move within the contract period, then the client will most likely say bye-bye to us, and then they will go to another company. Okay, but even the best investors underperform the market sometimes. Let's take Berkshire, for example. The late 90s saw the dot-com bubble. So it is a time when people were like quitting their jobs and becoming millionaires day trading tech stocks. And in 1999, a Barron's article suggested that Warren Buffett might be losing his magic touch, because during that period, Nasdaq went up by more than 100% and Berkshire share price dropped almost 44%. So now imagine that now if you're a Berkshire shareholder in 1999 and your friend just told you that they just made a 1000% from Yahoo in just 2 years, and Warren Buffett didn't even know how to use a computer, will you be able to stick to your original investment plan after hearing all this? Or will you buy more Berkshire or maybe sell Berkshire and switch to Yahoo? So it is very difficult to decide, okay? So sometimes I think today's investing is less about knowing more than everyone else about a specific stock or market, but rather our behavior, mindset, and the discipline that we maintain as investors or traders. So if you are willing to maintain a maybe 3 to 5 years time horizon, while others are thinking about the next month or next quarter, then we may have an advantage. Okay. So in this study, the author found that a significant portion of why people make certain investment choices can be explained by their genetics, or maybe can be attributed to their genetics. So these findings suggest that genetic factors plays an important role in shaping our investment biases and behavior. So we really can't blame ourselves when we have this kind of behavioral biases. So now let's imagine that this is the Stone Age. You are chilling among your gathering party, you are there picnicking, and then suddenly one of them like started running after seeing a shadow behind a tree. So what would you do? Do you think you'll walk closer to make sure that there is a lion behind that tree, or it is something that looked like a lion but was in fact a harmless animal? Or now is the perfect timing for Insta Story or Facebook Live? So if you are the adventurous or maybe the gung-ho type, chances are your genetics won't have the opportunity to be passed down to your next generations, right? So we are the direct descendants of those who survive by copying the behavior of the group. So while this instinct is good for maybe survival, but it may not be good for investing or trading. Okay. So imagine that now you're in a room with maybe 10 other people, then everyone has to come forward and tell the answer out loud, which line is the same length as the one on the left. And the 9 participants before you say that the correct answer is C. So will you doubt yourself? So this was the experiment conducted in the 50s. So, so in this experiment, it is a group of 7 to 9 participants. So other group members were the Confederates working together with the experimenter, and then they were instructed to give the same wrong answers in some trials. And the result is about 75% of participants conformed at least once during the experiment. So giving incorrect answers to go along with the group consensus. So why did the participants conform? So when they were interviewed after the experiment, most of them said that they had gone along with the group for fear of being the only strange person in the group. And a few of them said that they did believe in the group's answer were correct. So apparently people conform for two main reasons. Because number one, because they want to fit in with the group, or because they believe the group is better informed than they are. So overcoming herd instinct can be very challenging because as humans, we are quite emotional. So it is deeply ingrained in our behavior. So here are a few tips to help us resist the herd instinct. So we can maybe try to gather as much information as possible. So this can help us make a more informed decisions based on facts rather than emotions. Or maybe we can ask ourselves why we are doing something and whether it is really in line with our values and strategies. Or maybe surround ourselves with people who have different experiences than we do. And sometimes the best decision is to do nothing at all. Instead of feeling pressure to act quickly and copy the behavior of others, maybe you can take a step back and wait for more information to become available before making decision. Okay, so that was a herd instinct. So now, how can we determine Tunku Abdul Rahman's birth year without using Google search? So I'm sure most of us have seen this picture before, right? So if we use the year of Merdeka, 1957, right? Okay, which is 1957. And looking at this picture, this is not Tunku Abdul Rahman, this person standing up here. So we can see maybe 50 to 60-year-old man, right? So if you use 1957 and then minus 50 or 60, the estimate for the year that he was born will be in between 1897 to 1907. So the correct answer is 1903. So how did we figure that out? We use 1957 as an anchor. So anchors are like reference points we use to make guesses and judgments and decisions, but sometimes we may end up using them unnecessarily. So in this experiment, participants were asked to spin a wheel of fortune that was rigged to stop on either 10 or 65. Then they have to estimate the percentage of African countries in the United Nations. So the correct answer that time was around 35%. So participants who saw 65, they had an average estimate of 45%, while those who saw 10 had a lower average estimate of 25%. So in this experiment, the wheel of fortune worked as an anchor. And in another experiment, participants were asked to write down the last 2 digits of their social security number and estimate the length of the Nile River. And then the participants whose number ended in a higher number gave higher estimates. Okay, so since then, many studies have demonstrated the power of anchoring bias in a variety of, in many contexts, from negotiations to marketing to investing. So I'm sure some of us have seen this kind of advertisement before, this thing is worth maybe 10,000. If you sign up or buy today, you just need to pay 888. So this thing kind of sounds kind of familiar, right? So by setting an anchor point, which is the 10,000, marketers can influence how consumers perceive the value of their products or services. So why does this bias occur? So one theory is that our brains likes to use shortcuts to simplify our decision making. So by anchoring to a specific number or a piece of information, although that information may be irrelevant, we can quickly narrow down our choices and make a decision. So for example, around 20 years ago, departmental stores like Parkson were the go-to places for shopping. So their share price increased by a few 100% before the global financial crisis in 2008. And then in 2012, when Parkson was trading below its book value, I invested in it with a target price of 7 ringgit. So I used the previous peak as an anchor. So I still remember that in the past, brands like Padini or maybe G2000, if you're a guy, so can be found in Parkson. But now you cannot find them in Parkson anymore. They have their own shops inside the mall. So over the years, if you have a brand, it will be easier for you to reach consumer directly, especially with the rise of e-commerce, and then reducing the need for middlemen like Parkson. So luckily, after it announced weaker earnings for a few quarters in a row in 2013, I realized the mistake that I have made and shouldn't have used 7 ringgit as my target price, because it is very unlikely that Parkson's business will be able to return to its previous glory. So luckily, I decided to cut my losses in 2013. So anchoring doesn't only apply to the previous peak. It can also happen when we anchor it to the most recent lowest price or maybe our entry price. So I'm sure some of us maybe have experienced this, where we were wrong. Maybe we bought at a very high price with wrong information, and then the price dropped significantly from our entry price. Then we will tell ourselves that we will cut our losses when the price rebound back to our entry price, even though the entry price is not relevant anymore. And personally, I have missed out on many stocks that continue to trend up simply because I refuse to enter when the price had already rebounded sharply from the recent low. I'll always use the lowest price as an anchor, so I'll try to wait for the price to return to that previous level. Then obviously I missed the boat many times. So these mistakes, they don't show up in our investment returns, but they are a very huge opportunity cost. Okay. So far so good, huh? Okay, so let's say if today's fixed deposit rate is 10%, we will consider investing in other asset classes like stocks or properties. Or maybe if today the loan interest rate is 10%, we will be interested to take out a loan to buy maybe lands, properties, or maybe take out multiple loans to invest in properties, or maybe even start a business. So in the 70s and 80s, the landed properties in prime areas of Penang and even in KL cost only like 30 to 50,000, but now they are worth millions. So when the property market was booming like 10 years ago, I used to wonder why the older generation didn't take out more loans and invest in more lands and properties when they were young. So if you just take out multiple loans, everyone will easily be multi-millionaires by now. So unfortunately, things are not that easy, because based on the information I found, the fixed deposit rate in the 80s was nearly 10%. And the lending rate even hit 12% in 1998. So if I live in that era with this kind of interest rates, I don't think I'll be willing to take out a few loans to invest in properties. So once we know the outcome of an event like the property market, everything seems very obvious. We should have invested or bought more properties, took out more loans, or invested in the stock market 20 to 30 years ago. So psychologists call this the hindsight bias. Hindsight bias is the tendency to believe after an event has happened that we knew all along that what was going to happen. But the reality is that most events are complex and unpredictable. So why does this happen? So this is one of the reasons why we need a diary to keep track of our maybe decisions, predictions, and our trades, so that we know what's our winning probability, our win rate. So sometimes our brain is wired to remember the predictions that come true and forget the bad ones. And one of them is our memory. We tend to remember things in a way that makes us look smarter. So when I look back on my diary, I'll realize some of the really very silly mistakes that I've made throughout the years. And then another reason is our desire to be right. Because when we make a prediction and it turns out to be wrong, so we might try to convince ourselves that we actually saw it coming all along, or we may blame the information or something else. And then the information that's available to us also plays a role. Because after an event has happened, we will have more access to a lot more information than we did beforehand. So which can make it seem like we should have known what was going to happen. So in this experiment, college students were asked to predict whether this fella would be able to confirm to the Supreme Court. So before the vote, 58% thought he would be confirmed. But after he was confirmed, 78% claimed that they knew he would be all along. And in another experiment, participants might maybe initially rate the chance of a sports team winning at 50%. But after the game had ended, they will raise the rating to 70%. Or participants will maybe estimate a particular event to be at first somewhat likely and then change it to very likely after the fact. So investors who experience positive outcomes in their investment decisions were more likely to exhibit hindsight bias, so leading them to trade more frequently and take on more risks. So, and then it also leads us to overestimate our abilities and overlook the role of chance and other factors that may have contributed to the outcome. So this will cause us to believe that we are better at predicting future events than we actually are. So this sentence sum it up like perfectly when he said, all past declines look like an opportunity and all future declines look like a risk. Because it is easy to see a decline that has already happened on the left-hand side of the chart as an opportunity to buy low. But when faced with a recent decline in the stock market, we may become hesitant to invest or even sell our investments in fear of losing money. So this is what the chart looks like during the S&P's lost decade from 2000 to 2009, where it experienced the dot-com bubble and the global financial crisis, two financial crises in a decade. So there was a lot of news about the death of the buy and hold strategy after the global financial crisis, like in 2008, 2010, 2011. So imagine you have given up on like buy and hold or sell out stocks like maybe Apple, Microsoft. After all these news and reports and articles, the opportunity cost would have been very substantial. So now I'm sure you have seen this kind of statistics or news before, right? Like everyone thinks they are above average. Only 2% think they are below average, or maybe majority of people think that they are more intelligent than the majority of people. So in general, humans are quite confident, okay? So like in this study, the researcher found that 74% of the survey group think that they had delivered an above average job performance. So almost 100% of the survey group believe that their job performance was average or better. But statistically speaking, only like 50% of the sample can be above average, right? So this suggests that they have a high level of overconfidence among this survey group. So in investing, overconfidence can lead us to like overestimate our ability and the understanding of the financial markets. So leading up to my next mistake, I had invested in a few properties when the property market was booming, like more than 10 years ago. So during that period, if I remember correctly, people were even paying foreign workers to up to, I think, 1,000 ringgit to queue up and just book hot properties in Penang. Because during that time, you don't have to pay loan interest, so you just need maybe a few thousand to maybe 10,000 to book a proper 300 to 500,000 property. So once the property construction is completed, you'll be able to make at least 50 to 100,000. So the return on investment is very, very high. So at that time, I thought after I bought a few properties, I reached my loan limit. So I thought instead of buying properties, why not sell them to investors? And since I don't have the money to buy land and build properties, I researched and invested in a few like undervalued property and construction stocks. And 2013 was one of the best years for Malaysian small cap stocks. So the returns of the stocks I bought were impressive. They went up like a few 100% in a short period of time. And one of the companies I bought even get privatized at a very low price. So this was the first time my stock portfolio reached a 7-digit figure. So I became very, very overconfident. Okay, so after taking some profits on those stocks, I turned to look at this stock in my portfolio, which didn't really move much compared to other stocks. So it was trading at 7 times earning at that time. And then the earnings were starting to grow in the last 3 quarters. Okay, so I invested in this company with the assumption that the earnings will continue to grow for at least the next few years, thanks to the booming property market. So I kept buying along the ways, and then it became the largest holding in my portfolio. But unfortunately, as the property market is a cyclical market, I didn't knew it then. So it is hard for a property developer to keep growing its earnings like maybe Apple, Google, or Microsoft. So when its Q4 earnings started to drop, instead of selling the stock, I came up with my new analysis saying that the book value for this company is 360. And since property have gone up, prices have gone up quite a lot, eventually those land prices will be more expensive when they revalue. Then the book value of this company will be at least increased by 50%. So the target price, I set the target price to 5 ringgit. So there's still upside. So on top of that, it is still trading at a single-digit PE. So did you see what I did there? So when the reason that I'm buying the stock is no longer there, in this scenario, the earnings growth, I try to find new informations or reasons to support my belief that this stock will continue to go up. So consequently, I bought even more stocks when it was trading at below 3 ringgit. So instead of cutting my losses, I bought even more. And then a few quarters later, I realized the mistake that I've made because the property market was becoming more challenging. So I had to accept my mistake and cut my losses. So confirmation bias we suggest that we will be more likely to look for information that confirms our original idea. So that was a mistake I did back then. So today, with the rise of personalized algorithms, we are often exposed to information that aligns with our existing beliefs. For example, we tend to follow news sources or social media accounts and even online communities or blogs that echo our views. So if you are value investors, we'll most likely will read everything about value investing, right? So making it challenging to consider another alternative. So a lot of sites now tailor content to personal interests or even our browsing history. So causing new and different opinions to vanish altogether. So my Google search result may be different from yours. So we then land in the communities of like-minded people. So further reinforcing our convictions. So if we believe that the earth is flat, so we'll find more information that the earth is flat. So more news about the earth is flat will pop up on our phone or maybe desktops. So this will further reinforcing our convictions and the confirmation bias. So this may be one of the reasons why some people still believe that the earth is flat and moon landing is fake. Well, this experiment shows how much effort it takes to question our own theory. So in this experiment, a professor presented his students with a number sequence of 246. So the students had to find out the rule that the professor had written down. So they could generate their own numbers and they would get feedback or not, whether the numbers fit the rule. So most students will suggested 8, 10, 12. So the professor replied, fits the rule. So to be sure, they tried 10, 12, 14, 16, 18, 20, 22, 24, 26. By the way, you should be able to find this experiment on YouTube done by some other people. So the students concluded that the rule is to add 2 to the last number. But the professor replied, that is not the rule. So some even concluded that the rule is even number. And then the professor also replied, that is not the rule. So eventually, some students try a different approach. So 642 does not fit the rule. 1, 2, 3 fits the rule. -2, -4, -6 does not fit the rule. So only when they could no longer find a counterexample, the student says that the rule is this. The next number must be higher than the previous one. So this was exactly what the professor had written down. So how did they figure this out? Instead of trying to confirm their theories like 10, 12, 14, 12, 14, 16, they try to look for this confirming evidence. So in trading or investing, it is easy to find information that confirms our theory. So seeking diverse perspectives and consider maybe contrary evidence may be able to help us avoid confirmation bias. Okay, so if the doctor tell you this, I have to inform you, there's only a 50% chance of surviving this operation. So you can tell me let's do it twice then. So that's not how probability works. Okay, so in 1913, something incredible happened in Monte Carlo. So the probability of the ball landing on black or red is maybe more than 47%. So during that year, the ball had landed on black 15 times in a row. So many couldn't believe their eyes and take advantage of the opportunity and immediately put their money on red because it had to change eventually, right? So if you have gambled before, you know that's not going to happen, right? So, but it was black yet again and again and again. So it was not until the 27th spin that the ball eventually landed on red. So by that time, millions of dollars had been lost. So the gambler's fallacy leads them to believe that something must change after the ball had landed on black several times in a row. They believe that the outcome of a random event is influenced by previous events, even though the events are statistically independent. So let's take a coin flip, for example. The probability of getting a head or a tail on a single flip is 50%. So it is important to note that each coin flip is independent, and the outcome of the previous flip doesn't affect the outcome of the next flip. So therefore, the probability of getting a head or a tail on the next flip remains 50%. So that's how probability works in theory. So in investing or trading, each trade is also independent. So and past performance doesn't guarantee future results. So after experiencing a few losing trades, we may believe that the odds of winning trade must increase with each loss. Unfortunately, that is not true. Because I've lost more money when I try to double down after maybe a few losing trades, maybe 3 to 5 losing trades. So I've even lost more money because during that time, I still remember my longest losing streak in futures trading was like 15 trades in a row with a maximum drawdown of 60% within 3 months in 2011. So when I was on the futures team, every morning we would do something like this, the open position table to track like the long and short positions held by our clients. So it will be easier for us to update our clients when something happens. So strangely, whenever the market is like trending downwards or dropping, we often observe that usually more than 90% of our clients will be holding long positions. So the most common response we receive is that since the market has been declining for 2 to 3 days in a row, a reversal should be able to come soon. And then since the probability of market going up is usually 50%. So sadly, that's not how the market works. Sometimes a trend can last for months or even years. So when the market is like trending down, there will usually be more red candles than green candles, right? So, and when the opposite is true when the market is trending up. So for clients that are trying to predict reversals, they are usually right most of the time and make small profits when the market is in a trading range. But when the market started trending, they will usually be on the wrong side of the trade. So they will be holding like short positions in this scenario. So from my experience, maybe 99% of the time. So especially during the global financial crisis in 2008, and most of them refused to like cut their losses, and some even added to their positions until they cannot like tahan or top up anymore. So this is one of the reasons why most of the new traders in futures trading are usually wiped out within 3 to 6 months. Okay, now I'll give you some time to go over a few mathematical questions that I have solved over the years without using a calculator. Okay. So as you can see, I may be able to get the right answer, but the process is definitely wrong, isn't it? So sometimes a bad decision can also lead to a very good outcome, but it is definitely not repeatable. So outcome bias involves judging the quality of a decision based on the outcome rather than the process. So let's say if our strategy is to cut our losses when the price breaks below the support level, can we say that our decision was wrong if after hitting our stop loss, the price goes back up to the previous level? So next time we don't use our stop loss anymore. So as investors or traders, if we don't understand the process, then we can only judge a strategy solely based on the recent outcome, even though the process may be wrong. So let's take this strategy as an example. This is a back test done by the author of What Works on Wall Street. And this is the result of simply picking the top 50 stocks with the highest annual sales growth. So in the last 5 years, this strategy was able to grow 10,000 into 33,500. So nearly 4 times the return of the S&P 500. Now, if you were looking at this just in isolation, we will say simple strategy sounds good to me. So Morningstar will have a maybe 5-star rating on this fund. CNBC, Bloomberg will be covering the stories of the portfolio manager, talking about why this is such a great strategy, and the fund will be able to raise a lot of capital. So this is what happens when we value outcome over process. Let's go to the next slide and see what really happens here. This is the data between 1964 and 2009. Well, what really happens here is that the very same strategy would have underperformed even the treasury bill. So this was the previous slide. So the previous test was the return between 1964 and 1968. So as investors or trader, we have to think whether the strategy that we are looking at actually makes sense. So buying the top 50 stocks with the highest annual sales growth may have good returns in 1964 to 1968 when the stock market was hot. It was like the dot-com bubble in that era. But we may think that the 60 is not relevant. So guess what? The same strategy for the 3-year ending February 2000 compounded at 66% a year. And then again, before the recent bear market, there were like many like high growth but loss-making companies perform really, really well, right? And there was like stories on how they were going to disrupt the industries and so on. So one of the reasons why this strategy does poorly is because everyone buy those hot stocks when they were in the news. Analysts will have like rosy forecasts and the stocks will become very expensive. So they are sort of priced to perfection. So if they don't achieve it, or when the sentiment starting to turn, anything that can go wrong will go wrong, and at the worst possible time. So if we value outcome over process, we will be chasing after hot stocks or mutual funds that have the best returns recently. So Vanguard has done a study on performance chasing strategy, which bought funds with higher recent returns and sell funds with lower recent returns. So the study concluded that performance chasing reduced average returns by more than 2% per year. Okay, here is a great test. Among 1,000 participants, there were 5 engineers and 995 lawyers. When no information is given and we simply pick one name, everybody guesses the same way. The person must be a lawyer, right? So this will give us a 99.5% chance of being right. So in this scenario, we pay attention to the probability. Now, next, meaningless descriptive information is added. So Jack is 33 years old, likes to ride his bike to work. Then people started thinking, I can't see a lawyer riding his bike to work, right? So I know I shouldn't, but I'm going to assume that he may be an engineer. So in this scenario, meaningless information allows mistakes to start entering the forecast. Finally, stereotypical information is given. Jack is still single, shy, introverted, organized, likes to spend his weekends on a computer, hates parties. Then everyone says, I don't care, this guy must be an engineer. No, he wasn't. He was a lawyer. Who says lawyer can't hate parties? So the base rate information is important when we want to make decisions, especially those related to finance. So sometimes we have to exclude those specific situational information. So we tend to ignore the base rate when some situational or meaningless informations are given. And then another bias, the recency bias, which is almost similar to base rate neglect, is the tendency to overemphasize the importance of recent experiences or latest information when estimating future events. So when something happens, we will tend to think that this will go on forever. For example, when there is a crash, in airplane crashes or maybe accident, we will think that the probability of the next accident will be very high. So base rate neglect usually these two are almost similar, but the key difference is base rate neglect is more on the specific details, whereas recency bias involving giving more weight to recent information. So by combining these two biases, we can make very huge mistakes in our decision making. So for example, when there is a correction in the stock market or maybe economic slowdown or maybe bad news, people tend to think that this will go on forever and the market will not be able to recover, right, every time. So although throughout history, bear markets and drawdowns are a normal phenomenon, and we have seen how humans survive different crises, and despite so many recessions, bear markets, and even world wars, the markets have always recovered and ended up even higher. And equities or stock market were the best performing asset class compared to bonds, treasury bills, gold, and even and of course cash. And some of the listed companies were founded even more than 100 years ago and not only have been through all these tough periods, and they are even still growing right now. But guess which headline do you think will be trending during this period when there is a market correction or bear market like last year? The news market tends to recover over time and make new highs, or that the market is going to crash. So if every year we keep predicting that the market will crash, eventually we will be right. But imagine the opportunity cost if in 2011, after reading all these articles and news, we decided to sell out stocks like maybe Apple, Google, Alphabet, MasterCard, S&P Global, which went up some of them even more than 1,000%, and invested all our money into gold and silver like what our friends suggested. So the opportunity cost will be very high, right? So another example, the steel industry in Malaysia is cyclical. So the probability of these stocks to continue trending up like Apple or Google is very low. So therefore, it is more suitable for trading rather than buy and hold investing. So for turnaround plays, timing and valuations are very, very important. So they can be very highly profitable when the industry begins to improve. And usually when things are optimistic and profits are growing and the PE is very low, it is usually too late to invest in this industry. And the best time to look at these companies is when they are not making money. Like what happened here in, say, late 2020. So in late 2020, I noticed that most of the steel stocks were trading near their support levels. So 1, 2, 3, 4. This is the 5th time Anju hit this support level, and they are not making money. And I think that the trend may begin to change after the price started to break above the 200-day moving average. So after that, I started buying, and we forwarded this trading idea to our clients. Like, is this the beginning of a new dawn for steel players? Prices have been trending down and trading below like 200-day moving average for the past 2 years. Is the trend going to change as prices of these 4 companies starting to like trade above the 200-day moving average? So the stock price of Anju increased by more than 200% in 6 months after the quarterly earnings started to improve. So unfortunately, when these companies report like increasing profits for a few quarters, their PE will be very low. So investors tend to forget that the steel industry is cyclical. So instead of taking profits, one of my clients even bought more after seeing like this article. So they'll say that the earnings per share is very high. So can you find another listed company as good as this company? So you can see that this particular company increased their profits by a few thousand%. Now it's making 36 million a quarter. So there will be like reasons why this is considered a good investment, many good news, and why this time is different. So unfortunately, the stock dropped more than 50% after that. So base rate neglect involves neglecting general statistical information. And recency bias is like giving more weight to recent information. So beware of base rate neglect and recency bias. So now let's say that this 2-hour movie like cost us maybe 20 ringgit per ticket. And then after watching for 30 minutes, we realized that it is not what we expected. So the story is more about Captain Marvel than sharks. I want to watch sharks. I want something about sharks, but it's showing Captain Marvel. So what should we do? If we walk out now, we would have like wasted our 20 ringgit and 30 minutes. But the movie is only 2 hours, so we just have to tahan another 1.5 hours, right? So sounds logical. But if we do that, we would have fallen for the sunk cost fallacy, because we have spent the 20 ringgit and 30 minutes regardless of whether we stay or leave. So these factors should not play a role in our decision. So the sunk cost fallacy happens when we feel that we have invested too much to quit right now. So maybe do you have friends who are struggling in a maybe troubled relationship where the boyfriend or girlfriend cheated? Then they explain that they have invested so much time and energy in it, and therefore it would be like wrong to give up on the relationship. So this is another classic example of the sunk cost fallacy. So the time that we have been holding on to a stock or the time we have spent doing the research shouldn't affect our decision to hold on or sell a stocks. And have you ever wondered why we tend to take profits quickly and hold on to losses rather than letting profits run and cutting our losses? So theoretically, for someone who likes to gamble, they will hold on to like losses and also let profits run, right? And for someone who doesn't like uncertainties, they will like cut their profits and also cut their losses. So these theories explain it. So losses and gains are valued differently, and the pain of losing is psychologically twice as powerful as the pleasure of gaining. So for example, the pain of losing 100 is often far greater than the joy gained in finding the same amount. So another experiment again. So in this experiment, participants were presented with 2 scenarios involving the potential financial outcomes and were asked to choose between them. So in scenario A, a guaranteed 1,000, and scenario B, a 50% chance of gaining 2,005 and a 50% chance of gaining nothing. And then participants were also presented with scenarios involving potential losses. In scenario C, incur a certain loss of 1,000, and scenario D, a 50% chance of losing 2,005 and a 50% chance of losing nothing. And the result is, it revealed a very consistent pattern. So when facing gains, participants preferred the guaranteed option, which is the 1,000. And then when facing losses, participants were more willing to take the gamble, which is either lose nothing or lose 2,500. So this demonstrated that people are generally more risk adverse when it comes to gains and more risk seeking when it comes to losses. So this is one of the reasons why most people tend to cut profits and hold on to losses. Okay, so these are some of the common misconceptions we collected from our clients like over the years. Like the stock market is a form of gambling. The stock market predictions are the key to successful investing. So I've proved that wrong because I've asked fortune tellers a few times and that fella was wrong. Okay, so in order to be a successful investor, we need to know everything. No, we don't have to. And what goes up must come down, or what goes down must come back up. Or cut loss is a mistake, or triple loss is not losses, or maybe a 20-cent company is cheaper than a 2 ringgit company, or complexity is the necessary ingredient for success. No, sometimes a simple strategy can also beat the market. So I still remember that one of my clients' expression when I showed him my P&L for futures trading and told him that the entry and exit strategy I used was just price breakout. So a very simple strategy. Okay, just buy when the price break above 55 candles high and cut loss put below 5 candles low. So just sell when the price breaks below 55 candles low. A very simple strategy. And then we have to make all or nothing decisions. So I've encountered like many clients who refuse to split their entries and exits, even though they can afford to buy or sell like many units. For example, if they are holding a position of 100 lots, so they will insist on selling everything all at once. The idea of selling some or half is like killing them. So for me, when I'm sure, I prefer to maybe sell partially, let's say 50% of my position. So if the price continues to go up after I take my profit, I'll tell myself that luckily I only sell half. So on the other hand, if the price started to drop after I sell, then I'll tell myself, luckily I already sold half. So this is how I usually psycho myself so that I can control my emotions. Okay. Okay, one last experiment. So let's take a look at this experiment. So the scientists raised like 20 cats in total darkness. Then they were placed in a lighted box for 3 hours a day once they were old enough to walk. So these scientists are quite crazy, right? So every cat in this scenario were placed in a harness. So one of the cat's leg reaches the floor. So, and its walking movement will make that thing move in circle. And then the other cat's leg was restrained by the harness. So it could see everything that's going on, the movement, the other cat walking in the circle, but its leg never touches the floor. So it had no like active control. So after 8 weeks of these daily walks, the cats were brought into the real world. So they were tested to see if they could like, can they walk normally? Can they like do the cat walk? So the result is 100% of the cats whose leg had control over the movements, in this scenario, the active ones, were tested normal. And then the cats who only watch, in this scenario, the passive ones, can't do a cat walk properly. So they were like functionally blind. They can't judge the distance, the depth, and stuff. So they were like a bit cha-cha. So interestingly, these cats, both of them, they grew up seeing the same thing. But one experienced the real world, while the other maybe just merely saw it. So the result was that one was normal, the other one was effectively blind. So this leads us to think that one of the most important topics, like in investing or business, is whether all of us are in some ways like these passive cats. So I'm sure we have read about the 1997 Asian financial crisis, the dot-com bubble, even like the 1929 Great Depression, all the bubbles and financial crisis, but some of us didn't live through it. So if you started like investing in the 80s, the stock market went up more than 10 times before the dot-com bubble. On the other hand, if you started investing in the 30s, the same market went exactly nowhere. Or if you grew up in Asia, the Hong Kong stock market was the thing before the Asian financial crisis and global financial crisis, while the US market experienced a lost decade in 2000 and 2009. So some have maybe experienced the bull market in properties, while others have witnessed the gold and commodities rally. So what we have experienced is different from what others have experienced, and even if we are from the same generation. So this is one of the reasons why everyone has different goals, opinions, strategies, time horizons, and appetite for risk. Now let's take a look at this chart that compares the S&P 500 and a managed futures fund that employs a trend following model. So when we look at the past with the question, can we survive a 36% drawdown, 40% drawdown, 50% drawdown, or 60% drawdown? So on the Excel or maybe a spreadsheet, yes, no problem. But what about mentally? So it is easy to underestimate what a 50% drawdown can do to our psychology. Yeah, I've tried that before. It's psychologically very hard. So a 50% drawdown will definitely cause us to doubt our strategy. And maybe spreadsheets, Excels, they can like model the historic frequency, or our backtest can model this magnitude of drawdowns, but they can't capture the feeling of, say, maybe coming home, looking at your spouse or kids, and wondering if you have made a mistake that will impact your or even their lives. So seeing the world around us is not enough to understand how it works. We have to actually experience that world to learn how to operate in it. So by the way, 2 days later, all the cats were tested normal. So regaining their vision and learning how to match the world around them to their movements. So all of them can do their catwalks. So 8 weeks of seeing the world taught them like virtually nothing for those passive cats. So 2 days of experiencing it, they had it all figured out. So it also requires time to be a successful investor and trader. And experience is a minimum requirement for success in investing. So don't be afraid to lose or make mistakes. So losing is just part of the game. And some advice here. So instead of analyzing individual investments, we have to evaluate our entire portfolio, because in every portfolio, there will surely be losing stocks. Okay. And then keep our records so that we know how good we are, and then analyze our past trades for possible insights. Maybe you'll find that some certain strategies will be more suitable for your personality. And then the way to build long-term returns is through preservation of capital and home runs. And then, of course, we need to match the investing or trading method to our personality. And then not only to our personality, but also to our, say, current situation. Because, for example, getting rich and staying rich requires like different strategies. So for someone maybe where the portfolio size is less than 1 or 2 times of their annual income, diversification may not be necessary. So maybe a 1 to 2 stocks portfolio, or hentam on stocks that can meletup, or maybe futures trading, or even enduring a 50 to even 70% drawdown can still be manageable. But on the other hand, for someone with a portfolio size of, say, more than 10 or 20 times of their annual income, there will be different concerns, right? As staying rich becomes more important than getting rich. So diversification should be the main priority. Okay, a quick recap. So investing edge refers to something that gives us an advantage over other investors. So there are 3 types of investing edges. So informational advantages, analytical advantages, and behavioral advantages. And these are the biases that may cause us to lose money. So herd instinct, anchoring, hindsight bias, overconfidence, confirmation bias, outcome bias, gambler's fallacy, base rate neglect, and recency bias, sunk cost fallacy, prospect theory, and loss aversion. So personally, I have tried all this before. So I'll suggest that you try it and then record it down, so next time you'll know how to avoid this kind of error. So basically, that's all for my sharing today. So if you have any questions after today's session, feel free to connect with us. So thank you and bye-bye.
Thank you so much, Chiu, for doing this segment for us. As an inquisitive student, I always liked science classes when I was studying. And today, it seems like it's a science class in finance. So I find so much joy in hosting you today. I like the point that you give a lot of experiments and analogy to bring out the points that you want to highlight today. So thank you so much, Chiu. So if you have any questions to ask our speaker today, Chiu, please write your questions in the Q&A box. Yeah, write your question in the Q&A box, and we will address them accordingly. All right. Any questions so far? I think today, Chiu talk about investing advantages and also some of the cognitive biases and behavioral biases that investors often make without knowing them.
I think you can ask like some other questions that is not related to behavioral finance as well.
Maybe this is
Since there's no questions related to this topic.
too scientific, is it?
Yeah.
Okay. Yeah, you may ask any questions. All right. In relations to investing.
Can you
Okay,
share
yeah,
your
there's
trading
one.
strategy?
Siman
Which trading
asked, would you be able to share your trading strategy?
For stocks, usually will be like trend following and swing trading. So usually I'll use like 200-day moving average to identify the trend, or the higher high or higher lows to identify the trend. So if you are a trend follower, you can just follow the entry and exit signal. But if you want a higher winning probability, then you have to focus on swing trading. Well, like when there's a pullback, when there's a correction, and the winning probabilities will be usually like 70% for swing trading, whereas for trend following, the winning probability is only like 40%. Personally, I prefer trend following because I cannot tahan after I sell a stock, it go up like maybe another 50, 100%, or for futures trading. So personally, I use trend following more on rather than swing trading. Although I started as a swing trader, yeah.
I see. So what if there's no trend? What would you do?
Cut losses lah. That's why I lost 15 trades in a row last time because the market was very sideways.
I see.
Uh,
Yeah, I like how honest you are with us today. So how do you determine an acceptable level of risk in your investments? And what strategies do you use to manage and mitigate those risks? So this is a question by Jonathan.
Okay, for investment, I will focus more on quality stocks. The majority of my positions will be in quality stocks. So I'll exclude those riskier industry or riskier stocks, like maybe stocks with no pricing power, or stocks with high leverage or borrowings upfront. So that will sort of like help me mitigate the risk upfront. Then I'll buy into maybe at least 10 companies from different industries. It's like, for example, if I will avoid buying all glove stocks in my portfolio. So maybe I'll buy maybe one healthcare, and then one consumer staples, one technology, one semiconductor. So this is how I control and mitigate my risk. And then for my portfolio, I'll usually maintain a certain percentage of cash level depending on the market valuation, the stock market's valuation compared to other asset classes. So if I think that the stock market is expensive, so I will maintain a higher level of cash to control my risk. Then the cash will be invested in uncorrelated assets like maybe gold, or maybe managed futures, or maybe even treasury. So that's how I control my risk for investing. And then for trading, so you need to have a proper position sizing, whereas you can't let like one trade to ruin all your position. So you have to do your back test, preferably manually, and then see what is the maximum drawdown, and then you times it by 2. So that will be your position sizing strategy. Yeah.
All right. Thank you so much, Chu, for sharing your idea.
Okay, this one
Next question is, yeah.
For trend following higher high, so when do you enter again? So if you experience breakout, so you'll be seeing the chart will be sort of like climbing a ladder, right? So you can add on every time when price breaks new high. But my advice is maximum only 2 to 3 times. Usually the 4th time, the winning probability will be very, very low. So in this scenario, maybe your winning probability will surely be lower if you add on to your positions, but the magnitude of your gain will be larger. So this your performance will surely be better if you can tahan a lower winning probability. Yeah, usually stop losses and position adding on winning position will drag your winning probability lower.
Okay, thank you so much, Chu. The next question is, what is your view of the US economy right now?
I know I shouldn't say this because the economy is very hard to predict. So I'll just tell you some of the news that I've read over the past few weeks or days. So of course, the market is expecting the interest rate drop to a normal level next, or maybe in the next 2 years' time. Inflation is coming down, so that's why the stock market is at very near its all-time high. So everybody is like predicting the economy to be good, but I don't want to be someone that always tell you that the market is going to crash. And I believe that in the short term, there will surely be corrections. So my strategy is always to just buy onto the good companies that can survive any economic conditions rather than those that needs to rely on good economic to make a sufficient return to return that for investors. Yeah.
Okay, so the next question is asked by Faiz. So, what is your take on the way forward for the Malaysian stock market for 2024?
Wow. So I cannot predict the stock market. Yeah, I cannot give a buy or sell call to the public. But overall, actually, I'm quite optimistic with the Malaysian stock market. So if you have been investing for the past maybe 20 years, the bull run during the 2005 to 2007 was unlike the ones during the COVID rally. So during that time, like most of the stocks, even you simply buy, you can make 50 to 100% easily within a year. That has not happened since 2009 until now. So I believe that eventually a bull run will come for maybe the not only Malaysia, the emerging markets, because you can see that the emerging markets for the past 15 years or so have been underperforming the developed markets. So I think there's still chance. And then for Malaysian stocks, the valuations are definitely cheaper because there is no passive investing is not that popular in Malaysia. So we can gain some advantage by using like analytical skill lah. So I'm quite optimistic with the Malaysian market. Yeah, although most of my percentage of my portfolio are in developed markets, but I'm still quite optimistic. Yeah.
Thank you so much, Chiu. The next question is asked by Fuk Shan. Are you someone who do buy and hold strategies?
Yeah. I really love buy and hold. Some of my biggest winnings are those buy and hold like Visa or Mastercard, Google. So previously I started with swing trading. Then I realized that after I miss out on a big trade, I cannot tahan the feeling. So I switched into trend following. Then when I ventured into investing, I tried like small cap value and momentum stocks. But that kind of investing, you need to be right. Like you need to find a new stock every time after you sell. Maybe Tambun, you need to find Pintaras. After you sell Pintaras, maybe you need to find SHL, something like that. But for buy and hold, you just need to be right maybe once. Microsoft or maybe Meta or maybe Google or maybe Hermes or LVMH. So personally, I prefer buy and hold. So if next time I have the opportunity to launch a fund, I'll stick to the buy and hold strategy on quality stocks. Yeah.
Thank you so much, Chiu. So the next question is asked by Ahmad Tajudin. So do you think that we are still in the risk of recession?
The US one or the Malaysian market?
Maybe you can comment on both.
US ones, okay, according to the news, not my analysis, so the risk of soft landing is higher than hard landing, because previously the market was predicting a hard landing. There was like a negative yield curve and stuff. But now, based on the situation, we can see that the probability of soft landing will be higher. So technically, the GDP has been dropping for the past 2 quarters, but they said that was not a recession. So there was no recession according to the Fed also. So for Malaysia, I think the economy is still quite strong. GDP is still growing, so the risk of recession is quite low.
All right. Thank you so much, Chiu, for sharing your perspective. So the next question is also quite macro. So what is your view on the Japanese yen? So this is a question by
So
Kyung.
if you like scroll through Instagram, you see a lot of people in Japan, right? Despite there's like nuclear water or something. So I think the Japanese yen is quite low right now. So personally, I do look into Japanese stocks. Some of the stocks are quite good, like Oriental Land Holdings or Japan Stock Exchange. I'm not sure about the stocks that Buffett bought. Overall, the Japanese economy is quite different from the US and the Malaysian market. So I think it can provide a very good diversification. So, but I don't really have the opportunity to buy into it yet. So I don't really have the experience to tell you that whether Japanese yen is good or bad right now. But I can tell you that it's quite low, seeing that so many people going to Japan this month.
Yeah, take advantage of the low currency. Yeah, I think Japanese yen is the weakest currency in the Asian currency at the moment, I guess.
Yeah.
All right. So the next question is asking you your view about the Hong Kong or the China market. What is your view?
Actually, I'm quite optimistic about the Hong Kong and China market. I personally have exposure in Hong Kong and China markets through stocks like Hong Kong Stock Exchange, Guizhou Maotai, even Tencent, or the ETF called like KWEB, which focus on China internet stocks. So maybe I can share this screen. Hold on. Hey, how do I share my internet?
You want to share a browser, right?
Yeah.
Yeah, you
Yeah.
just click share screen and go to the browser.
Okay. So you can see my browser right now, right?
Yes.
Okay. Why I can't load this? Okay. So China is considered as emerging market. So I think the weightage for China stocks are like 30% in emerging markets. So this also includes like Malaysia, Taiwan, Korea, and stuff. So this is the ratio of emerging versus developed markets. So when the ratio is quite high, it means that the emerging market is expensive, more expensive than the developed markets like the US and the Europe or Japan market. So when this ratio is very low, it means that the emerging market is cheaper. So if you have studied the market, you'll see that from the year 2000 until 2009, that decade was the performance of the emerging markets for that decade was very good compared to the US market, which just experienced a lost decade. And then subsequently, when the emerging markets became expensive, then the US, which is the developed market, start performing well again, right? So now the ratio is about here. So I think the emerging markets is definitely cheaper compared to the developed market. So I think there's still chance to get like decent returns from the emerging markets. And then even if the emerging markets does not perform, maybe I need to show you this. There will be stocks that outperform the market in the long run. I'm still at my browser, right?
Yes.
Okay. Wait. Okay, so this is it. So for the past 10 years, the emerging markets only gained 36%. But if you are right, or if you are able to pick the right stocks or quality stocks, you'll still be able to outperform the market and get like decent returns. So I think it is more on picking the right companies at this juncture, regardless whether it is in emerging or developed markets. But overall, I am still very optimistic about the stocks in Hong Kong and China. Yeah.
All right. Now we know that the US presidential election will be happening next year. So the question from Bernie is that would this affect the US stock market and the US dollar?
Definitely yes, but we will definitely be wrong because I still remember like 2016, everyone was saying that when Trump becomes the president, the market will tank, right? The market will drop, like even like George Soros lost like a few billions from that bet. So I think it is very hard to predict, but that I can definitely tell you the market will definitely be volatile if some unexpected things happen, but I can't tell you in which direction. Yeah.
All right. So among all the biases that you shared, which bias do you think that happen among all the retail investors the most?
I would say maybe anchoring
Anchoring. Okay, could you
to
provide
the
some
irrelevant
examples?
information most of the time.
So they anchor on irrelevant information.
Yeah,
Okay,
especially
for
the entry
example.
especially the entry price, because most of our clients, that when they refuse to cut loss, they'll say, oh, when the price come back to my entry price, I'll cut loss. This is the response I get every time. So mostly on anchoring, or even when the price rebounded, they refuse to buy. They'll tell you, oh, previously the price was only like 1 ringgit, so now it's 120, so it's move up 20% already, so I'll wait and see. I'll wait for the price to come back to 1 ringgit. So even though that 1 ringgit may not be relevant anymore, so most of the times are like anchoring. Yeah.
I see. Thanks for sharing. Yep. The next question is by Kyung. So since that you mentioned Japanese yen is very low right now, do you think it's a good opportunity to buy yen in batches as a whole for 1 to 2 years?
Personally, I don't trade in currency, so personally I won't do that. But if according to your analysis, if the yen is low, you can try that lah. Because for me, I prefer to buy stocks, but some of the Japanese stocks are sort of like expensive right now because the yield is quite low. So if you look at companies like Oriental Land, it is trading like at 80 times PE. So although the yen is low, but the valuation for that stock is high, so it makes me like in a dilemma whether to buy that stock or hold yen. So that's why I didn't have the opportunity to buy Japanese stocks yet. So personally, I won't hold yen. But if you think that the yen is cheap based on the analysis, so maybe you can try, yeah, maybe high yield product, currency product. Yeah.
All right, thank you so much, Chu. By the way, whatever that's mentioned here is only for case studies. So it shall
Yeah.
not, whatever view that speaker share is just speaker's opinion, and it shall not be construed as any investment advice. All right. Okay, looks like there are no more questions on my Q&A panel. So I want to thank all of you here for writing all your question in the chat
There's
and also
another
in the
question.
Q&A. Oh, there's one more. Okay, there's one more question. Let's do this as a last
What
question here.
what do you think? What will be a good annual return? If you can
What
outperform
benchmark should we do?
uh,
What would be a good benchmark?
for global or US stocks, if you can outperform the market by 3 to 5%, then you are very good. But for Malaysian stocks, maybe you can outperform the market by more than that lah, because our FVM KLCI is practically not moving, right? So maybe you can outperform the market by 8 to 10% a year should be achievable lah. So for Malaysian stocks, if you can outperform by 8 to 10%, I think it's quite decent. So for US or developed markets, 3 to 5%, it is considered very, very good, because I think less than 1% can do that. Yeah.
So if US S&P is doing 10% return a year, you should aim to get 15%.
Yeah.
Yeah. For Malaysia, you gotta have more like 8%, like 8 to 10%. Okay. All right, so that shall conclude our session here today, The Art of Losing with Mr. Chew Huat Jin. So ladies and gentlemen, you just heard from Mr. Chew Huat Jin, who is the remisier of Malacca Securities. All right, so thank you so much, Chew, for sharing with us, what are the common mistakes, common biases that investor make, and how we should avoid those pitfalls. Thank you so much, Chew.